Those of you who are expecting to see me on my own, I'm sorry to disappoint you, but what we have done is decided to change the style of this morning. We're going to have a round-table discussion, so let me introduce the guys that you can see on stage. Chairing the session in the centre is the editor of Insurance Times, Saxon East, and Saxon's promised to be fairly gentle with us, so we'll make sure he sticks to his promise. He's flanked by Mark McQuilcombe and Ian Jacob from Delegates, and they're on stage to talk about the work we've been doing on unconditional risk transfer and to give a broader comment on some of the other regulatory areas that we'll touch upon. So probably enough from me. Saxon, do you want to kick it off?
Okay, well, hello everyone. Thank you for coming today. I'm sure you've enjoyed your networking so far and some of the sessions. So thanks again for coming. I think we're going to start off with a presentation from Deloitte about risk transfer, which you're going to kick off with.
Yes, sure. Thank you very much, Saxon. I wanted to start this morning by saying thank you to BIBA, and particularly Steve, for inviting me to speak here on a topic that's been billed as the big issue. So I've put my smartest suit on and turned up to sell the big issue. We heard from Martin Wheatley yesterday about some of the ways in which the broker's new regulator, the FCA, is changing UK regulation. These changes include focusing on understanding business models, focusing on customer outcomes, proactive intervention, increased use of thematic reviews. There's a lot of rhetoric, but as yet, there hasn't really been enough time to get much experience. So the first question that I wanted to pick up on this morning is what should you be expecting? We've put together a slide of some of the hot topics that Deloitte's seeing, both existing and emerging, in regulatory relationships. I wanted to just pick up on a couple of these, otherwise would probably take you for the whole session. But the first and probably most important is product governance. It's the cornerstone of the FCA's focus on conduct regulation. And for them to really understand where the next PPI might be, the FCA is starting to look at how products are designed and monitored throughout the distribution chain. And that's to ensure that all products are designed around fair customer outcomes. It means that wholesale markets in the insurance industry can expect questions on conduct and product governance, where before they probably could get away with it being the sole concern of the retail markets and the insurers. Similarly, add-ons are another area of press focus in the wake of the PPI scandal, as politicians and regulators question whether customers really understand the add-on products that they're being sold, whether they really need them, and whether they have an opportunity to opt out. And that's sort of hitting the motor market, obviously, added value accounts, and legal protection insurance in personal lines. The next topic I wanted to pick out was the conflicts of interest. This is a bit of an emerging theme that we've seen in the market. Conflicts are an inherent part of broking, and at different times, brokers act for the client and at other times for the insurer. And in most cases, historically, this transition between roles has been quite seamless. What the FCA is finding is that a lot of firms can't really articulate how those conflicts piece together, or indeed how they're managed, and how in managing them, firms are putting consumers' interests first. It's particularly significant in groups that have MGAs, and that's where we've seen a lot of challenge coming out. Lastly, and this leads into our next theme, the FCA last year started a consultation process formally on client money. That includes an enormous number of recommendations, and really is a comprehensive review of the client money rules. A couple of things from the consultation paper I think we can take as certainties. The first is that firms will need to start really looking at the strength of their reporting and the strength of their systems. The second bit that I wanted to pull out was around unconditional risk transfer. Now, this was mentioned yesterday on the big stage by Steve, and again this morning in his introduction. But what we have is a regulatory environment where a number of different buzzwords, a lot of them were on the previous slide, start to point towards whether risk transfer can continue as a viable option for brokers. Now, BIBA recognises that risk transfer is actually a critical part of the business models of its members, and it sees it as something worth protecting. The FCA has welcomed risk transfer because, in its views, it protects consumers, ensuring that their cover is not threatened if a broker fails. Brokers also like risk transfer. There are a number of reasons for this. Firstly, full risk transfer means that you actually have the option to avoid the CAS regime, which is expensive now and, by the looks of things, getting more expensive to implement. Another factor is around TC4. This is what's now become the appropriate resources threshold condition. Firms that hold client money typically have higher TC4 requirements. And firms that have a combination of risk transfer and non-risk transfer money have an argument to reduce that TC4 number. Those that operate under risk transfer can lower the capital requirements even further. Against that backdrop, there's a number of threats at the moment to risk transfer continuing to operate. The first is this move at the FCA towards unconditional risk transfer. The practical implication of a move to unconditional risk transfer is that brokers throughout the market are likely to need to repaper their TOBAs with insurers. That's against a backdrop of insurers that are more sophisticated about how they manage risk, partly because of Solvency II. And so there's a risk if all the brokers turn up to the insurer's doorstep at once, that the insurer takes a look at all the risk transfer in front of them and has a serious rethink about whether it wants to give risk transfer at all. Fundamentally, I think in any event, insurers are taking an interest in how their money is protected by brokers. And the FCA proposal on unconditional risk transfer effectively increases the credit risk to them. So in the light of all of that, BIBA's asked Deloitte to help them to create a framework of controls that demonstrates professionalism to the insurers without loading too much cost into the broker's business model. The aim of this is to secure risk transfer as a viable alternative to the client money regime for the industry. We started off by looking at risk transfer from an insurer's perspective. We looked at the risks posed to insurers, and we did this by starting from the Solvency II framework of risk assessment. That made sure that when we start then thinking about the controls to mitigate the risks, we're only focused on the bits that really matter to insurers. Once BIBA and Deloitte had created a basic outline of the proposition, we started talking to insurers and brokers. This research was really useful. It gave us a number of very clear messages, and I'll start with the messages that we got from insurers. Firstly, a lot of insurers actually already consider their risk transfer to be unconditional in reality. And that's because the reputational risk of completely walking away from their policyholders' cash that's sitting in a broker if it fails is so great that they simply don't think they would do it. Now, that's all well and good. I think the FCA's concern with that is that it's a nice theory when everything's going well. If there's any grey areas, then they're trying to stamp it out by creating this unconditional risk transfer. The other thing that we found from insurers is that the vast, vast majority support continuing to use risk transfer to secure their distribution channels. the next thing that we found was that although insurers have always reserved the right to audit firms that they give risk transfer to, and that's often in the TOBA, in the contract with brokers, it's never really been exercised, and the insurers really don't have a large resource available at the moment to go out and check to see how their money's being managed. That means that they're very receptive to a single unified system that they can rely on to get more assurance over how their money is held without having to employ great swathes of auditors to go out and pester brokers. Messages from brokers were also clear. The first thing that we found was that for a large number of particularly smaller brokers and an enormous proportion of the membership of BIBA, full risk transfer is absolutely critical to the business model. The other thing we found is that a lot of brokers have risk transfer with a large number of markets at once. So a system that allows them to hold the money in a pooled, segregated account is absolutely critical. And a unified framework that all insurers sign up to, which permits that, is the only way to make that, well, is a good way to make that possible. The last thing that we found from brokers was that they were wary about loading unnecessary costs into their business models. So any solution, therefore, needs to be flexible and not one size fits all. So having taken all of that feedback on board, we created a controls framework, which you'll see in a moment. To make it really work, we've also created a suite of additional documents that sit alongside this framework. BIBA's aim is to make this solution fully accessible to all its members. So alongside the documents, the aim is to publish guidance and to help members in implementing this without the need to shell out for all of our fees. So I'm going to finish now by showing you sort of roughly what the controls framework looks like. I won't go through it all in detail, but I will talk through the structure of it. You'll see there are broadly 3 columns on the slide over there. The first column is the risk that we've taken from the insurer's perspective. There are 2 risks, and the 2 risks are both related to the credit risk associated with giving risk transfer. The next column sets out a series of 9 controls objectives. And the point of these objectives is to make them something that the insurer will rely on, but equally something that a broker looks at and says, but of course, if I'm being sensible with somebody else's money, these are the things I would expect to need to do. The final column is, we've called it suggested control. That's where we hit the it's not a one-size-fits-all message. We've given an idea of the sort of controls that would meet the objectives, but we've left it open to individual brokers how they set up their internal controls so that they can make sure that it's truly proportionate to their individual business. So, for example, to take one of the CAS requirements, if you're in the CAS environment, you need to bank checks within 1 business day of receipt. If you're a small broker and you only have a couple of people in the office and everybody goes on holiday in the summer, day of receipt may not be possible. But the objective that we've given you is to do it promptly. So firms are then able to take promptly and say, well, in the context of our business, how do we make sure that fits how we run ourselves? So that's it in a nutshell. And we now welcome questions from the floor on how it will work. And I'll hand back to SAXON.
Well, thanks very much for that, Ian. That was an excellent presentation. I'm sure everyone would agree on that, and that's outlined some really key points there. I know, Steve, you've talked about this, at length, but just for the sake of the people who haven't heard you yet, very simply, what are the worst case and best case scenarios here?
I'd rather talk about best case scenarios than the worst case scenarios. Let's just put into very simple language, what you've just heard Ian say. Insurers are looking at whether they are prepared to give unconditional risk transfer. And just so we're all clear, unconditional risk transfer very simply means that if the customer can prove he has paid the broker, then there are no circumstances whatsoever that the insurer can go back to the customer and say, you need to pay me again. The insurer can chase the broker around the planet and around the galaxy to get his money back, but he can't go back to the customer. So we've been involved in one-to-one discussions with the major insurers to see whether they are prepared to do that. And most of them are saying, yes, we are prepared to give unconditional risk transfer to most intermediaries. We then get to the second stage of what then does the insurer want to happen to his money? And our fear at the start of this process that insurers would say, I'm happy to give you unconditional risk transfer, but I want the ability to audit my money if I want to do that. And of course, you can't audit money in a pooled bank account. So we were facing the prospect potentially of the insurer saying unconditional risk transfer, potential audit. That would mean separate bank accounts for every insurer that said that. Now, I would suggest that would be an admin nightmare for most of you. Hence the engagement with Deloitte to say, can you build us a systems and controls suite that would allow insurers to say, rather than audit the money, I'd like to audit the systems and controls around the money, because you can audit systems and controls around a pooled bank account. So that's the reason that we have done what we have done. The final point that Ian didn't quite reach was we've taken the systems and controls that you've seen, we've given them to Beechcrofts, the lawyers, and Beechcrofts have produced for us a trust deed that reflects those systems and controls. That trust deed is now out with the insurers, and we are getting insurers' consent on a drip basis for brokers to use that. So the bottom line on this looks like most insurers are likely to allow most brokers to have unconditional risk transfer, to allow them to pool their money into a single account, and then that account be the subject to potentially a systems and controls audit. So that's a summary of where we've got to. Worst case scenario, I don't think we're going to get to a worst case scenario because that's where most insurers are headed. I think the one thing we'll all have to reflect upon is where you have risk transfer cascaded down a distribution chain, because there's no pattern at all as to whether insurers are prepared to allow cascading, if so, to who and how and under what circumstances. This model won't easily address that. This model much easier addresses that one-to-one insurer-intermediary relationship. But we've been talking to the Deloitte guys as to how we can develop it to cater for that cascading and distribution issue. Maybe we can talk about that in a little while.
A couple of points to add, Steve. And one of the big advantages of this potentially is that you could get a situation where you only have one audit a year as opposed to having 20, 30 or however many sets of risk transfer you've got with different insurers. So it'd be a framework that everyone signs up to. Going back to Steve's point on risk transfer or cascaded risk transfer, we spoke to a number of MGAs and informally to some of the insurers. And I think if other intermediaries in the distribution chain also signed up to this framework, this template, the insurers seem to be looking quite favourably on cascaded risk transfer. But I think it very much comes to everybody signing up to this idea and this concept of a standardised treatment and system of control for client money.
Okay, excellent. Well, thanks for that. So some good outlines there. And what I was going to say was we're very keen to hear from any questions from the floor. So does anyone have any questions at all they'd like to ask the experts here on risk transfer?
So just to be clear, this solution is basically nothing to do with replacing the existing client money rules or the proposals from the FCA. What this is about is safeguarding risk transfer, which a significant part of the market rely on. The FCA, in my view, likes risk transfer because it means that the monies are protected by an insurer's balance sheet, which has greater assets than a broker typically. But this is not about alternatives for statutory trust or non-statutory trust or a solution to those brokers that choose to comply with the CAS rules. This is just a proposal to attempt to safeguard risk transfer. which is obviously very important to a number of brokers.
Are there any other questions on risk transfer? It's the gentleman just in the far corner there.
Hi. It seems to me that most regulatory questionnaires or controls are based upon the question, asking a question like, do you have risk transfer from your insurers? And the answer is either yes or no. It's not, I've got 99.999%, but I've got one little thing over here which goes through a distribution change with 2 other brokers. Therefore, I haven't. Therefore, I can't say yes to the question. Therefore, I've got to do a lot more work for the 0.001%. So for you to say that you have got in place the controls and procedures for the direct insurer-agency relationship, which is absolutely a doddle compared to all the others, doesn't really, in my view, advance us much towards a situation, a solution which is generic and workable.
Steve?
One of the things that the new regulation is going to be doing when it frees up its IT manpower is to have a look again at the RMAR return. And I think what we will see probably in the medium term is a much more detailed set of questions that you're regularly giving the regulator around client money. So rather than have those generic do you or don't you, it will be you have a client money permission or you don't. If you do, where is the money going? Is it going stat, non-stat? Are you commingling, or are you holding your risk transfer monies outside of the CAS rules? So I think more detailed questions from the regulator to get around that issue you have there with generic questioning.
Just a couple of points on that. I mean, it's almost the same answer again. This obviously isn't a solution where you are holding non-risk transfer money and risk transfer money together. So where it's commingled, obviously you still need to comply with CAS 5. What this might give you an opportunity though is if you have got a very, very small amount of business that's not on risk transfer and you're complying with the client money rules, you could potentially segregate that into a separate entity, have that entity where you focus on CAS compliance and making sure that your systems and controls are absolutely watertight in that one entity with your small amount of non-risk transfer money, and then the other entity have all your risk transfer business and sign up to this framework. That might be a solution to your challenge.
And one of the things that the FSA consulted on 2 years ago was the potential for a client money fee block. Now, I'm pretty sure that in the fullest of time they will go back and reconsult on that. So we could be looking 2 years down the line at paying an additional regulatory fee if you have a client money permission. Now, remember, if you're holding client money and risk transfer money in a CAS account, a commingled account, all that money becomes client money for the purposes of the client money rules, and the fee that you will pay for your client money permission will reflect all that money, not just the small client money proportion of it. So there could be a financial incentive to separate client money and insurer money, leaving the client money in a CAS account and moving the insurer money that you might have previously commingled out of CAS and into a solution that looks like that.
Now, it is important that the CAS rules attach to an entity. And obviously an individual entity needs to get permission from the FCA to hold client money. So you would need 2 regulated entities to do that. But it is a solution, and it might be a very attractive solution if, as Steve suggests, it has fee implications. But I do think it makes it a lot more simple to run your business and reduce regulatory risk if you were to separate the 2.
Excellent. Well, thanks very much for that, Mark, Ian, and Steve. We're just going to change the pace slightly now. We're going to talk a little bit about Steve and then broach into some other regulatory issues. I think it's a good opportunity for Insurance Times to ask a few questions about Steve and his appointment as Chief Executive, which happened this year, so it's still fairly recent. So Steve, I mean, how did you feel when you won the role? I mean, because we know that obviously the competition was quite stiff. So how did you feel when you achieved it?
I was delighted. I'm the 7th CEO of BIBA. It's the first time that the association has promoted internally into that role. I think that's great testimony to what Eric built in terms of his team. I was proud to be a part of that. I think it's a sign that BIBA is going in the right direction. It wasn't felt by the stakeholders that there was a major rebuild needed. So from a building perspective, there may be a bit of repointing, but not tearing down walls and building conservatories.
Okay, excellent. And you mentioned Eric there. I mean, from our perspective at Insurance Times, I think we thought that, and I know a lot of people agreed with us, that the former Chief Executive, Eric Galbraith, was excellent on his presentation and networking skills. There's some of his strongest attributes. So, Steve, what kind of attributes do you think you'll bring to the role?
I'm getting quite decent feedback from the presentation I made yesterday, so we can maybe put half a tick in that particular box.
Judging by the tweeting, definitely.
Yeah. I think it's a sign that how important compliance is. Compliance underpins everything that insurance brokers do. I'm not just a compliance person. I know I'm known for compliance. I did 21 years within a general insurer, a broker-only insurer, so I've not just got compliance and regulation on the CB. There's an awful lot more than that. And it was obviously a combination of skills that ticked boxes for the people that were making the decision.
And I think one of the things that you're known for in the wider industry, Steve, is your sort of technical grasp is, quite admired. Obviously now moving up to the chief executive role, do you still feel that you can keep that level of technical grasp, even though you're in quite a high managerial role?
Well, clearly the association needs to have a look at how it resources for the activities that it does. You'll have heard me say yesterday, as part of our strategic review, that we're looking at the executive resources. And with that regard, I've got two announcements to make now. Firstly, we have agreed an outsourcing arrangement for BIBA's compliance inquiries. So the phone calls and the emails are now being picked up by our friends at UKGI. That launched a month ago and has gone very well for us so far. We're upping the ante with regards to the profile of that now. We have Rick and Nikki in the hall with Bob Beckett. Please, if you don't know them, go and say hello afterwards. They are doing and continue to do a really good job for us in handling those inquiries. They have a call centre there that does that, so we're not reliant on one person. And secondly, we are replacing me. I'm delighted to announce this morning that David Sparks, who may be known to quite a lot of you, ex-Broker Network, ex-FSA supervisor, and now employed at Marsh. David has accepted a role within BIBA to become our compliance and training manager. We haven't yet agreed a start date with him, but he will do a fantastic job. So for those of you in the audience that come along to our regional compliance forums, I know there's many of you in the audience that do that, David will be picking up and running those as we go forward. So we're thrilled to manage to land our first choice. To use a footballing analogy, we set our target in the transfer market and we went out and got him. So he'll be a good signing for us, I'm sure.
Excellent. Well, that's good news, Steve. Obviously, to see you're keeping up that momentum in BIBA in terms of keeping on top of the regulatory and compliance issues. So moving on to some of those issues which we think are going to be quite important. I mean, I know speaking to brokers that, one of their concerns that I constantly hear is that the FCA, I think a lot of brokers feel the FCA is particularly harsh as a regulator, perhaps even harsher than the FSA from what we've seen. What do you think, Steve, in terms of the regulator? Do you think it's a regulator which is shown to be calm and understanding, or do you think it is one which is a bit harsh on brokers?
The FCA came into being on the 1st of April. We're 6 weeks on? I don't think it's a little bit early to be judging quite that just yet. If you look at the legislation and the powers that they now have, they have powers to ban products, they have powers to ban advertising, they can be more intrusive, they will be more proactive. The analogy that we use with them, and we told Martin Weekly this, and he said that is absolutely perfect. We use a driving analogy. Those who come to our forums will have heard me say it, but I'll say it again. To use a driving analogy, the FSA was a rear-view mirror regulator. It was looking into the rear-view mirror, looking at the accidents it had driven past, reversing the car back to sort them out, so PPI being the classic example. The FCA is going to be a driver that looks out of the windscreen, looking up the road, identifying the hazards it sees ahead and dealing with them. We heard Martin talk yesterday of a new issue on interest swaps, which 5 years ago would have probably been handled an awful lot more differently by the FSA. What the FCA have done is gone into the major banks, told them there's a problem and told them to get on and sort it, which they are now doing. There's been some comment in some of the financial broadsheets about this change of approach. The consumer groups don't like it because the consumer groups thought this new regulator was going to be much more consumer friendly. But the political reality of the world today is that the FCA and regulation is now a political football. We only changed regulator because the Conservatives in their manifesto said the FSA was a failed regulator and it would be replaced. With that in mind, politically, the regulator can't be seen to be repeating the failures of the past. So it needs to keep bad news stories off the front page of the Times, the Telegraph, and the Financial Times. That is the reality of the world that we're in.
And Insurance Times.
And more importantly, Insurance Times, obviously. So the regulator will work harder behind the scenes. It'll nip these things in the bud a lot quicker. Yes, it has the powers to force firms to do that. 2 or 3 things they're doing on the general insurance space that absolutely emphasise that point. They've been doing some work on before the event motor legal expenses, where they will be putting out a report, I believe, probably by the end of May. I would suggest, had they done this work 5 years ago, we could have been looking at a Dear CEO letter for everybody involved in the private car market. But that's not what they're going to be doing this time. They're going to give the industry a year to sort out some of the issues that they have identified. You heard Martin, yes, he talk about opting in and opting out. The regulator wants firms to allow customers to opt in rather than forcing them to opt out. At this stage, they're not forcing by rule changes firms to make that switch, but they are leaning on firms to get them to do that, and some of the bigger firms have already made that change. They're doing some work on add-on products, as again Martin would have said yesterday. That's a longer-term piece of work. We're expecting some sort of output probably Q3 this year. And the other one is in premium funding in the commercial insurance market, where again 5 years ago you may have seen the regulator go down a Dear CEO route. This time it's a fact sheet that sets out what they expect from firms, and they'll be going out and about doing thematic work to make sure that firms have engaged with that and have changed practices should they need to do so. So a subtle change is not just a change of logo, it's not just a change of colour above the door, it is a change of style underpinning.
Can you have a perspective on that, Saxon?
Please.
Yeah, of course.
I mean, I think at times the FSA and the FCA is getting perhaps unduly criticised for its regulation of insurance intermediaries and brokers. And I think if we look at the last 5 or 6 years since regulation came in, I mean, E&O claims cases have demonstrably come down in brokers, and I think that's a reflection on better systems and controls and just better governance. So I think that must be a good thing generally. Also, I think in terms of broker failures, there have been very few, almost none, broker failures since the FSA started taking over or started regulating brokers. So I think there is an argument that things have gone pretty well. I think there's going to be a step change now, and this is just a personal view, but I think what you're going to see is you're going to see far more focus on your business models, far more focus on where you're making your money, how you're making your money, whether it's appropriate. Obviously, Ian talked about treating customers fairly and product governance. Absolutely, making sure that when you design a product, when you sell a product, it's really got the outcome, the consequences that were intended when the insurer and the broker put those things together. I think that's key. I think actually the FCA is going to be a lot more joined up between the brokers and the insurers and looking at the handover points between them in terms of product governance and design of products. I think historically you'd go and you'd speak to an insurer and an insurer would say, actually no, the brokers design those products, they interact with the customer, and the brokers would say, actually no, we think the insurers design the products, they put the capital up. We all know in reality it's a combination of the two. And I think you as brokers need to get better joined up with the insurers and work as a team together to make sure that the products that are designed and sold are appropriate for the consumer. So I think it's, the FCA is going to be far more focused on business models, conduct, as Steve said and Ian said, far more forward-looking. I think it will mean actually that some of the smaller firms that haven't seen much of the regulator will get perhaps quite short and sharp, but themed visits focusing on specific areas, and in my view, they'll predominantly be conduct-related areas.
Excellent. I'm just saying, judging by this session, you can see that the depth and detail that you've covered some of the big regulatory issues is very good. And, I know working with you, Steve, that, you work very hard, your team works very hard. But there is a bit of a paradox in that we often get calls some brokers feeling that actually BIBA isn't fighting hard enough for their cause, it's not doing enough for them. Do you think that BIBA needs to then work harder at communicating its message to brokers?
Well, I think those firms that maybe don't think we challenge the regulator enough will take us some comfort by the language and tone that I took with the regulator yesterday. It's important to point out that there was nothing I said to the regulator on stage yesterday that we haven't said to them face to face. But we need you, our members, to see us say that. And the regulator knows that the trade bodies do that. We do give them a tough time. We don't shout at the regulator very often, but when we need to shout at them, we do. And when we do that, they say, well, crumbs, it must be a serious point because BIBA has shouted at us. That relationship works very, very well. When I joined BIBA, the board gave me an instruction that we wanted a constructive relationship with the regulator. And that's what we have tried to engender. I think the fact that we got Martin Wheatley on stage just a month after the regulator has come into force was tantamount to that. There were a number of his supervisors in the audience as well yesterday, so the FSA were there fairly mob hand, and some here today as well, for which we are we are grateful.
Excellent. And, you know, the FCA is a big topic. We write about it a lot. We get a lot of calls on it. Is there anyone here who would like to ask any question to Steve or the panel on the FCA? The gentleman down there at the front.
Steve, is this on? Do you think the FCA is or is becoming a price regulator?
The FSA had no remit to look at price, and I think one of the things it was frustrated about was I think it realised that inability to challenge price was something that didn't allow it to get too involved in the PPI situation. They have a competition remit now, and that competition remit will allow them to have a look at pricing if they want to go that route. Now, whether they have an appetite to do that is another matter. They don't want to go disturbing sort of market dynamics, but the remit that they have from a competition perspective will allow them to price in that area. Mark, did you want to?
I don't personally think they will. I mean, you've thought about it quite a lot internally.
I have thought about it quite a lot. I mean, you know, the FCA has this new competition remit. It's gained it in an environment where there are already two bodies that look at competition, the Competition Commission and the OFT. That means that there is already a framework for looking at how competition operates. And I think in terms of pricing, there are examples, and we're all aware that they exist in broking, often with add-on products, where the level of commission is much higher than any other equivalent part of the insurance policy. And where that happens, I don't think the regulator is likely to come in and say, you've priced this wrong. I think what they will say is, we've looked at it behind the scenes. We've seen the enormous amount of commission that you're getting for potentially not a huge amount of work. How do we change the way in which you disclose information about your remuneration to give the customer that knowledge as well, and then allow the customer to make the educated decision?
I mean, I personally think it's about fairness, not pricing.
Yeah.
I think they're looking for more transparency, and it goes back to what I said about the business model. Ian's point is really that they'll look at what parts of the business make the most money, and they'll challenge whether that's appropriate. I don't think they're not at all saying that it's not appropriate for brokers to make money. They're not saying it's not appropriate for certain products to earn more money than other products. They know about the enormous amount of value that insurance brokers add to the distribution chain. For me, it's about fairness, not price.
Okay, so we've only got a few more minutes left in the session, so I wanted to touch another topic. This one's about Europe. You know, I think we're all increasingly seeing more regulation coming out of Europe, and Europe being a real factor in terms of governance on UK firms. So picking out one particular topic, which is the IMD, the Insurance Mediation Directive. Do you want to explain briefly what that is and what it could mean for brokers? It's quite far down the line, but
Well, my regular audience will know I can talk for ages and ages and ages on European matters, so this really will be squeezing a quart into a pint pot. The European Commission published draft revised text last summer. That text is now in the European legislative process. That is a parallel process. The European Council of Ministers are considering it, as are the European Parliament. That's happening separately in parallel. Those two pieces of work are going on at different paces. It's ground to a halt at council level because the council has been tied up in banking union. But at Parliament level, they have an ambitious timetable which they are currently keeping. So the European Parliament may reach a point sometime this summer where they have a final text. But it needs council to get to its final text before the thing can go further forward. The key issue that I'm sure will interest most of the audience is the treatment of commission disclosure. The European approach to commission disclosure is vastly different. The Northern Scandinavians, with the exception of Sweden, have outlawed commission, so they're in a net-rated environment, whereas 4 of Europe's largest 5 markets, Germany, France, Italy, Spain, are all silent on how you are remunerated, let alone how much you are remunerated. So coming to a standard minimum position on disclosure is going to be very, very difficult for the Europeans. The model that we like, of course we would say this, wouldn't we, because we're Brits, is the Commission disclosure upon request, but at European level most countries want what they have got themselves. We think on request is a reasonable solution. It is as transparent as the customer wants it to be. So any customer that wants the information can have it, but it doesn't burden firms on giving it to everybody where they perhaps wouldn't want it. There is pressure, however, on the Commission model around Europe and domestically. You've all seen the RDR in the UK. IFAs now are unable to earn a commission where they give advice. The European equivalent, which is the revised MiFID 2, is currently drafted to say commission ban where you give independent advice. And there are certain countries in Europe where they haven't made the investment GI firm split that we made here back in the 90s. And there are some schools of thought, certainly amongst the more left-wing political parties, that if you've got the same firms selling the whole range of products, why can't they have mandatory disclosure right the way across the piece? So there is pressure on the Commission model. It's very difficult to say which way this will play out. Naturally, we're doing all we can at European level to end up with an on-request regime. We play a very active role within BIPA, the European Federation. There are guys from BIPA in the audience today. One of the beauties of all the work that we have done going out to Brussels every other month for 5 years is that now at European level, European brokers speak as one. We think as one on all the major issues. Lobbying is about what the ear hears, not what the mouth is saying. And at European level, the ears that matter are hearing exactly the same message. European insurance brokers think the same things about the revised directive. To use a cricketing analogy, we've all got the same 11 players. They may not go into bat at the same order, but we've got the same 11 players. So rest assured that the European intermediary voice is at one on all the key issues with regards to the IMD. As soon as we know in more detail the direction of travel, we will obviously let you know. The timetable, as you can guess from what I've said, is fairly unclear. As that becomes clear, again, we will let you know.
I think just two quick points on that. As Steve said, that the timetable just isn't clear, and we all know that European legislation has to go through quite a tricky process. So, when this happens, for me, it's not something that you need to get enormously worried about now. It's an emerging regulatory risk. Secondly, a lot of it depends on how the FCA interprets the guidance that comes out of Europe. So there's another hurdle there, because these things are quite subjective. We've seen with Solvency II that things are open to different interpretations. We've seen with the IMD as it is that the FSA, as it was, took a different view of interpretation of IMD to some of the other regulators around Europe. So for me, there's a long way to go on this.
Okay, so thank you very much for that, Mark. We covered, a broad range of issues, right from what's happening in Europe, right from risk transfer, right from the FCA. I think it will be clear to everyone that we really are entering a new regulatory landscape. Steve, you're at the helm of BIBA. It's going to be very important in fighting the cause of brokers. If you have one message to brokers out there, what would it be?
We want to drive the cost of regulation down, and to do that, we need the regulator to be convinced that we are a low-risk area. So whenever the regulator has a point of contact with any insurance broker, he needs to have confidence that the broker is being compliant. Compliance means lower fees. I think that's a point to leave it on.
Okay, well, we've covered a broad range of topics. I really hope you've all enjoyed it today. Mark, Steve, Ian, I'm sure you'll put your hands together and congratulate them for performance. Cheers.
Cheers.